Welcome to the Small Business Tax Savings Podcast, your weekly dose of accounting and tax tips specific to small business owners. You will be on your way to growing your business and paying the least amount in taxes as legally possible. Here's your host, Mike Jesowshek, CPA.
Welcome back to another episode. Today we have a special guest on, and the topic that we're going to be talking about today is this idea of a charitable remainder trust. And our special guest today is Dr. Guy Baker from BMI Consulting. Guy, welcome to the show.
Well, thank you very much. It's nice to be here.
Awesome. So this idea of a charitable remainder trust is something that we see for individuals that are going through an asset sale of some sort. And so before we kind of get into what is a charitable remainder trust, we want to talk about what are situations where a charitable remainder trust would be something that a client would be interested in. So what is the problem that arises where a CRT can help fix that?
Well, as a tax accountant, I know you probably work with a lot of clients who are in the process of selling assets. Maybe they've had for many, many years where they have low basis and lots of gain, and they're looking at the tax consequences associated with that. And they're saying, gee, Mike, how do we solve this problem? And so a CRT is a great way to be able to eliminate some of the capital gains and monetize it, turn it into income for life.
That's awesome. And so is there typically, we're talking about a highly appreciated asset. So this could be a business, a piece of real estate. This could be you bought Apple when it first came out and now it's grown a lot and you have a lot of appreciation there. This could even be, we see this a lot with crypto, people that have purchased crypto and has had massive gains on that. So let's kind of jump into this idea of a charitable remainder trust, also called CRTs, if you see those around. So, Guy, just explain, what is a charitable remainder trust? What is kind of the high-end concept of it?
Sure. So a lot of the explanation is really right in the name, right? So it's a trust, charitable remainder trust. And so being a trust, that means it's a separate entity that has its own tax ID number, and you have to set up that trust. And then remainder, well, let's deal with charitable. So charitable means that when you put it into the trust, it's going to go to charity. And what goes to charity is the remainder after you get the income. So essentially, it's a partnership, if you will, with a charitable donor advised fund or a specific charity or charities. But they don't get anything from the trust until after you've taken the income out over your lifetime, and if you're married, your spouse's lifetime.
Awesome. So, the idea behind it is, one, we can avoid tax on an appreciated asset. We can still provide income for a certain period or life. And then we can also take care of a charity on the back end. Right.
And then don't forget there is a tax benefit, a current tax benefit against other income that comes from it as well. You get a charitable deduction.
Yeah, that's a good point. So let's use this as an example. Let's say we're selling an asset, doesn't matter what it is, but it's an appreciated asset, and we're looking at a gain of about $1 million. Walk me through the process of utilizing a charitable remainder trust, and what does that look like as far as kind of taking advantage of this?
Yeah, so the most important thing that I think your listeners want to be aware of is that this has to happen before you have a deal. So that $1 million has to be transferred title-wise to the trust before you have a confirmed transaction. If you don't, then you don't get to avoid the capital gains. So let's say, you're selling stock and you want to call your broker up and sell your Apple, right? You've got to put that Apple stock into the trust before you call your broker and have him execute a sale. So now that you've got the $1 million in there, let's say you've got, I don't know, 100, 200,000 a basis or whatever it is, that 800,000 that would have been taxed on your income tax return escapes tax. So you have net $1 million sitting in that trust. 200,000 is your money and 800,000 is the gain. So at that point in time, the way you determine your tax benefits is based on how old you are and how much income you're going to take out. And you have some control over that in terms of how you design it. It can be based on a fixed amount or a percentage. And depending on how old you are and how much you're going to take out, you will get a tax deduction. The younger you are, the less remainder is going to be there. So the less deduction you're going to be able to receive. The older you are, the more remainder you have, and the higher your deduction.
Yeah, that's great. So that's a good thing too. And I want to really stress this idea. And this becomes, whether we use a charitable remainder trust or some type of charitable trust or some type of other tax strategy, the key about these types of transaction is talking to an accountant, talking to someone before you're even looking at making the actual sale. It's important that you start these conversations early so that you're not coming to an accountant saying, hey, I just sold my crypto for $1 million. Now what do I do? By that point, it's too late. So we have this $1 million asset that we're going to contribute. We contribute it to a trust that we created, and we get a tax deduction when we contributed that to the trust. Now, it's obviously, as you mentioned, going to be a discount of that. So even though we might have put in $1 million, our charitable contribution is going to be much less of that because we're not giving that $1 million today to the trust or to the charity, correct?
That's correct.
Okay. So now that the money is sitting in there, we make the sale. Because it's sitting in a trust, there's no tax owed on that sale of that asset because the trust owns it.
Yeah, no, that's exactly right. So, on $1 million of selling an asset for $1 million with 200 of basis, that's 800,000 of gain. You could be saving $250,000, $300,000 of tax by doing that. Okay.
So now we have this sold asset. We have $1 million of cash sitting into this trust. No tax has been paid on it, but now that money's in a trust, what happens from that point on?
Well, it depends on your age and how you set up the contract. But let's take two scenarios. You're 45, 50 years old, and you're only interested in avoiding the tax and having this money sit and grow for some period of time, and you're going to turn it into income like you might a pension. Okay. You would use a charitable remainder trust that allows you to defer the income until, say, you're 65 or 70. And then at that point in time, that income would go out. So let's say you set that up for 7% on $1,070,000, but because you deferred it, that million might have doubled in value to $2 million. And because you deferred income of $70,000 a year for 15 years, you could maybe take out, $250,000 a year for 10 years. On that particular arrangement. If you're older, if you're 65 or 70, say, and you're doing this, then you might want to take that income immediately, in which case, let's say you're 65 and you want to defer Social Security till you're 71, okay? So you might use the charitable remainder trust income to make up for what you would have gotten as Social Security if you'd have taken it earlier. And so you pull that out, but now you start taking the Social Security. So you want to defer income on the charitable remainder trust for a while just for tax planning purposes. So there's a lot of flexibility in this that allows you to mold your income based on what your cash flow needs are and what your tax temperature is.
Okay. Now, at what point in a CRT does the money go to, or does whatever the remainder is, go to the charity?
Well, that happens at death. So, or 20 years, depending on how you set it up. So, if you're 70 and you set it up then, at 90, it might terminate and go to the charity. But if you're 45, that 20 years isn't going to start until you're 65 or 70. And, there's ways to be able to extend it even longer than that, depending on life expectancies.
Okay. So I know a question that pops up on this. Let's say I have some children. I just put $1 million into this trust. I'm providing some income over the course of my life, and all of a sudden on death, that $1 million that was in there maybe grew, maybe had some paid out to me, but there's still some asset left in there, there's cash left in there. What happens to my family now? Because traditionally, if I would have paid the tax on that, they would have inherited that asset. So is there a way to still take care of your family in this type of situation?
Yeah, there's a couple of things that can be done here. What often happens, especially if there's a high desire to create an inheritance legacy for the kids, for the grandchildren and children, let's say, you might want to buy enough life insurance that can be funded off of the income from the tax savings. You could justify it that way. That would replace that. You may be able to design the charitable remainder trust so it has a beneficiary that goes beyond the two spouses. But again, those are all design considerations.
Okay, makes sense. So I just want to kind of wrap up this idea again. The remainder trust, the purpose of it is to avoid tax on appreciated assets, provide income for a certain period of time or for your life, and the remainder goes to trust. And we're able to avoid tax on an appreciated asset because the trust can sell your asset without paying tax on the capital gain. So this usually involves transferring something to the trust, letting the trust sell it, and then paying an income to you from the trust for the remainder of your life. Now, this all sounds great, but what are some of the downfalls? If you had to look at this and say, okay, here's a reason why here are some of the downfalls of this, because we've talked about a lot of positives. What are some of the downfalls to a CRT?
Yeah, so let me just give you a quick example, and then we talk about the downside. I'm thinking of a client of mine that's 48 or 9. He owned a privately held company. The three partners gifted a portion of that to a charitable remainder trust, so about $1.5 million each. They got about $175,000 deduction. They're investing that to grow, to create income when they're age 70, which is projected to be somewhere around $300,000. Okay, so that's a pretty good outcome, and it's a pension income that they can count on. But from a downside point of view, number one is they got rid of $1.5 million worth of value. If that company increases in value over the next 5-10 years to $2.5 million, $3 million, $4 million, they're not going to put that money in their pocket, but it will be in the charitable remainder trust, and it will create additional income for them if they've designed it properly. So they've lost flexibility and liquidity in that type of situation. From a tax point of view, there's really not a downside per se because the CRTs have been around for decades, so the law is very clear cut on that. It's black and white. But from a deduction point of view, if he'd have put $1.5 million in directly and didn't have any benefit from it on the other side, he would have gotten somewhere around $1.2 million, $1.1 million deduction, whereas he only got $175,000. So he sacrificed some tax benefits by doing it this way. The other thing is that you don't have as much flexibility investing that money. You're a fiduciary for the charities that are going to get this. So, you're not going to be able to buy some of the things, or invest in some of the assets that you might have chosen to invest in with that money in a CRT.
Got it. Is there a certain dollar amount of a gain when from a cost, this obviously is a fairly complex setup. So is cost involved in the setup? Is there a certain dollar amount in gain where this starts to make sense, or where the cost maybe doesn't make sense for it?
Well, I think you got to look at facts and circumstances. It depends on somebody's total net worth, what the value of the asset is, their tax tolerance. So those are all issues. The cost of setting these things up are really nominal. I mean, it's probably in the under $5,000 range. So, if you're putting $100,000 in, that's 5%. So you might not want to do it for that. You put in $200,000, it's 2.5%. Maybe that's getting a little closer to a good cost benefit ratio. What I like to do when we get into situations like this is kind of do an algorithm that says, okay, $1 million, how can we put money in their pocket and reduce the rate? So if we're looking at a $300,000 tax, maybe we only put $600,000 or $700,000, into the CRT, in which case then we're escaping tax on, let's say, 700, right? So that's using 30%, that's 210,000. And we take as income 300,000, but we get the write-off, say, of 100,000. So we're really only paying tax on 200, which would be 60,000. So we knock the tax down from 300,000 to 60,000, and we've got 240,000 of cash in our pocket.
Mm-hmm. Yeah, and that brings up a good point. So, traditionally, we're avoiding the tax on the sale of the asset, but we're still receiving an income source from it. And so that income source that we're receiving, for a certain period of time or for the rest of the life, is obviously going to be income to us. How is that income from that typically taxed?
Well, there's a 4-tier taxation application there. So your basis comes out tax-free, so you don't lose your basis. Capital gains comes out as capital gains, so you don't lose that. You still retain your capital gains rate, but who knows what that rate will be when you start taking that income. And then you've got interest and dividends. So it just kind of depends on what the makeup is of the asset. And so you have to have an administrator that's going to track those 4 buckets.
Okay, makes sense. And so is there some ongoing annual fees for that administrator that's kind of preparing those types of documents for you?
Yeah, it's just like a pension plan. You got to have somebody track that, and it's got reporting that you have to follow.
Okay. Awesome. Now, one thing that, when people start to research and hear about these strategies and say, okay, this sounds like great. I have a highly appreciated asset I want to sell, want to avoid capital gains, still receive income. This is great. They'll start to research Charitable Remainder Trusts, and they'll start to see things like a CRT or a CRAT or a NIM-CRT. So explain to us a little bit about that and what are those terms in comparison to a Charitable Remainder Trust?
Sure. So I mentioned early on in our discussion, Mike, that you could take out a percentage or a fixed amount. So that's what those are referring to. So you can have a CRAT, which would be a charitable remainder, that's the CR, annuity trust. We're going to set the fixed amount, and you're going to get that every year. And even if the asset doubles or triples, that amount's not going to change. Okay. If you use a CRUT, which the U stands for unit trust, okay, then you can get a percentage. So if you set it up for 7% and the asset doubles or grows while you're pulling money out, then your income can go up. The NIM-CRUT is talking about a makeup provision that's the one I told you about earlier, where you're 45 and you defer the 70,000 income for 15 or 20 years, and then you can draw down on all of that you deferred in addition to the percentage that you're going to take out.
Excellent. Well, Guy, this has been extremely helpful. And for those of you that are listening, we're also going to have a Guy and his partner, Jonathan, on our tax minimization program on one of our monthly group trainings. We're going to deep dive into this, go a little bit deeper. We wanted to do an initial kind of overhead look at what is a charitable remainder trust, and then take it deeper in our tax minimization program. So if you're not a member yet, be sure to check that out. Go to taxsavingspodcast.com/tax. We have tons of tax strategies in there. You have access to our team for those general tax and accounting questions you have. And we're going to be doing a monthly group training session with Guy and Jonathan that kind of deep dive into it a little bit further. So, Guy, anything else related to the charitable remainder trust you think would be good just for this kind of high level overview of the CRT?
Well, I think you stated what is probably the most critical aspect of this whole process, and that is to get into a discussion with you or their tax advisor or CPA ahead of time and plot this all out and get some economic models designed so that you can see the benefits of the annuity or the trust or the unit trust or the NIM-CRUD and whatever, and run some projections on how that money could be invested and what it might grow to and what the pension would be. This is really a private pension plan if you think about it. I mean, what you're doing is most people, when they reach age 65 or 70, don't care whether they're worth 20 million, 50 million, 100 million, or 2 million or whatever, right? What they care about is how much income am I going to get? And so one of the ways to assure income is by making sure you don't pay more taxes than you have to and convert those taxes into income. And I think that's done best by starting with a qualified tax advisor like yourself and get this all sketched out ahead of time.
Yeah. And for our listeners, that's really what I want to stress too, is the point of our conversation. We talk about tax strategies. We're going to tell you oftentimes how to do them, exactly what's involved with them. Other times, like the Charitable Remainder Trust here, our goal is to get that out in front of you and know that the possibilities are out there. But this is definitely something you don't want to try to do yourself. We want to find someone that's a professional and get you introduced to it. But our goal here and through all of our podcasts is to let you know of the strategies that are available out there, because so many people think that they're too small to save taxes or there's no way to save taxes when that's just simply not true. And this is just another example of how can you sell a highly appreciated asset and pay no tax on the sale of that asset. Most people would say that's not possible, or most people would say that's not legal. But here is something that's time and tested and proven by the IRS to be legal and utilized on a daily basis. So Guy, one other question to finalize this that as I was talking about that I thought of, this sounds in many ways to be too good to be true, or a strategy just seems like, wow, why would the IRS allow that? Is this a strategy that is scrutinized by the IRS? What is their take on this?
The key to the success of the strategy is the appraisal. So, if you've done the right job of planning, gone to the right professionals, it's set up by the right people, I don't think you have anything to be concerned about. What you might have to be concerned about is defending the amount of money that you put into it in terms of your income and your deduction. So you need to get an appraisal. But again, your professionals will help you do all of that. And as you mentioned earlier, it's black letter law. I mean, these have been around for decades. I don't really see much risk in this unless you don't operate it properly or you set it up wrong.
Yeah. And that's what we talk about. When it comes to advanced planning, the key is to finding someone that is going to do it right. Getting it set up correctly is so key when we talk about advanced planning, as well as, why we work with partners like Guy and Jonathan that make sure that we get this thing set up right. We've vetted them out and know, okay, these guys do things the right way. And so that's really the key importance whenever you're looking at an advanced tax strategy. And again, a reason why this is meant to be an informational purpose to say, hey, I might qualify for this. I don't know. Maybe it's not the right fit, but at least it's out there. Now you can research it, and now you can find the right vendor that you want to utilize to implement this. So, Guy, I just want to say thank you for coming on. Again, for those listeners who want to deep dive into this, we're going to be digging much further into the Charitable Remainder Trust in our tax minimization program. You can join that at taxsavingspodcast.com/tax. And Guy, just let us know that we'll also have a form within our blog, which is in the show notes for this, where you can submit it, and I can get you introduced to Guy and his team if this is something that you at least want to explore might be right for you. And then, Guy, just kind of explain a little bit more about what you guys do and where you can be found.
Yeah, well, thank you. It's been great to have this conversation with you. We're money managers and we're strategic consultants for our clients. Our goal is to help people achieve their financial objectives, both from the standpoint of how they invest their money and how much they don't have to pay in taxes that they can then invest. So, we work with people with significant net worth in order to be able to help them protect, preserve, and conserve, what they've built during their lifetime.
Excellent. So listeners, if this is something you're interested in, check out the form on our blog post. Otherwise, join our tax minimization program. We're going to be deep diving into this again with Guy and can get introduced then. And until then, I just want to thank you, Guy, for jumping on. This has been really, really informative, and really looking forward to seeing how we can open up the idea of tax savings and tax elimination potentially as well. So thanks, Guy, for coming on.
Well, thank you. It'd be great to continue working in this area with you. And if anybody has any questions, we'd love to help them.
Okay, sounds good. We'll see you in a couple of weeks, Guy, when we jump on the tax minimization program.
Okay, thank you. Bye, Mike.
This has been another episode of the Small Business Tax Savings Podcast. If you enjoy our weekly episodes, please leave a review and share with other business owners. You can find previous episodes and more information at www.taxsavingspodcast.com. Thanks for listening and have a great day.